Okay, good afternoon and welcome to the New Capital webinar, first quarter review and market update. My name is Catherine Barr. I'm the Director of Communications at New Capital. If you have any questions during today's webinar, you can use the Q&A tool or the chat tool. It's at the bottom of your webinar menu. It's at the bottom of your screen. If you can't see the webinar menu, if you bring your mouse or cursor to the bottom of the screen, it should show up so that you can use those tools during the presentation. We're going to answer any questions about the content of the webinar in a Q&A session at the end, and we can address any questions at that time. So welcome to the webinar. Thank you for joining us. We're glad you're able to be here this afternoon. And before we get started, I'm going to read the regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Thank you. And before we get started with the market presentation, we have a couple of NCM updates to just kind of discuss really quickly. First of all, Q1 reports were released a few weeks back. And they are available on NCM 360. If you have not yet set up your access session and you're not yet able to log in, this is the URL that you can go to get an access session scheduled with me. We'll do a fairly brief, or as long as you need, but a brief video call where I can get you logged into the system and kind of give you a brief orientation to the system. So if you haven't done so yet, this is the URL you can go to. That's the scheduling calendar for those access sessions for 360. Along with reports, obviously we have a whole lot of other data, and we're releasing a lot of new tools on a regular basis. So actually the next talking point is a new functionality that we're really excited about. And I think that a lot of the access sessions I've had so far, we've had a lot of questions about this. So we're really excited to kind of announce that this is coming very soon. And what it is it's the associate user access. What this means is that non-New Capital clients, so whether that's your adult children or other people who you want to be able to share your personal data with, you can grant permission to people outside of the New Capital client base. You can grant them permission to see certain areas of your data. And it's kind of a neat system. You can pick and choose what data you want to show and what data you want to hide. And so we're really excited about this. I think that a lot of people have indicated a strong interest in this. One of the key features of NCM 360 that we think is really important, aside from personal organization of your data, is also the ability to pass on your data to the next generation, in case of death or accidents or just mental deterioration as we age. So it's nice to be able to pass that data on to someone, and it's actually stored in one place. I know Leonard has mentioned the concept of the scavenger hunt. So a lot of times in the situation where someone passes, the next generation and their beneficiaries and their heirs are on a scavenger hunt to get all of their data. And if you are going to put the effort into putting your data into NCM 360, which we hope that will be of interest to a lot of clients, we don't want that data just to be lost. So we want to be able to pass that on to the next generation at your discretion. And so now we're creating a system that allows you to do that. So that'll be coming very soon. It's another reason to go ahead and get signed up and get logging into the system. And we'll be making announcements when that's available.
And let me add, certain areas of your profile, you may want adult children to have access to. And then I would think everybody would want their executor to have access to certain things. You may want your CPA to have access to certain things, but not other things. And so all these people can be defined as associates. They are your they're your associates, and you can define which of the modules in the NCM 360 that you want to grant them access to. So we're putting the finishing touches on that. All right.
Yes.
Am I going to take this one?
Yeah, I think you were going to take on that one.
Okay. So I think that you all will be delighted to hear that we have completely converted all of our internal communication systems to Zoom. We were using the RingCentral product, which had a version of Video Zoom, but we know that after the pandemic, virtually all of you, if not all, literally all of you, have Zoom on your phones, you have it on your computers, you have Zoom accounts. And so we've gone all Zoom. And we had a choice. We could have gone with the Microsoft Teams product or the Google product, but we said we want to be where our clients are for video, and by and large, that's in Zoom. So we are now all Zoom internally. All of our internal chatting and a lot of the calling and so forth is in Zoom. And if you want, we can add you we can invite you to join up with us on Zoom, our profile and your profile, so that we can actually conduct chats through Zoom or phone calls or things like that. Why would you do that? Well, that way, rather than using your phone's text messaging, we would have our own chat, and all the discussion between us would be contained within Zoom. And so we can do that if you want. We just have to send you an invitation. So let us know if that's something you want, and then it just gives us another mode of communication. And then we expect to be doing more with Zoom, and we're very happy with them. We think they've done a great job to change their product from just a video only product to a full company communications product. And our conversion has been effortless. And we also expect that that the connection quality is going to be better too. They kept telling us that even though we were using a RingCentral product that had a Zoom white label version within it, that we may not have been getting the fastest video speeds. And so we're very happy about that. Thrilled to let everybody know we are now all Zoom all the time. Catherine, you want to take this one?
Sure. I know that we're a lot of people may already know, we've announced it several times. We moved offices to our new office in February. Is that right? Early February? And
late January.
Was it?
Yeah, late January.
Late January. And so we're starting to schedule more client meetings. We're starting to reach out to you guys to schedule more review meetings. So this is just a reminder. We are no longer on Montrose. We are at 3355 West Alabama. It's in a mid-rise office building on West Alabama, directly behind St. John's School and Lamar High School. We're loving our new office, and can't wait to welcome everyone to the new location.
And it's great. We like the new building a lot. It's got a gym in it, and it also has a little lunch deli place. So if you want to come for lunch, we're happy to have you come for lunch. And they've got pretty good sandwiches and specials and stuff. I had chicken teriyaki special for lunch. It's pretty good. So if you want to come for lunch, we're happy to have you come for lunch. And then I'll take this last one. We've talked about Swiss accounts, and we now have a signed agreement. Here, I'll show it to you right here. We've got pages and pages of signed agreements with we think it's pronounced Vontobel, but it could be Vontable. There was somebody in our office the other day who called it Vontable, but I'm going to call it Vontobel. This is a Swiss banking institution, and we have the ability now to open for clients accounts there. And as I've talked about, why would you want to do that? And I'm opening my account first. I always experiment on me first before I release it to whatever it is to you. And so we're opening my account first so I can always work out the bugs on me. It isn't free custody, unlike at Fidelity, where custody is free. We made a pioneering deal with Vontobel. I don't think they've done it with any other advisor. It's 30 basis points, but the more New Capital clients who open accounts there, they're going to bundle us together and we get a lower fee. The more people, I think the first break point's $20 million. So if a whole bunch of New Capital clients open accounts and we pass 20 million, then I think it drops to 25 basis points, and then 50 million, it drops to 20 basis points, etc. And so why would you want to do this? Well, Switzerland is one of the oldest democracies in the world, and there are, I think I talked about this in other webinars, but there are organizations that rate democracies, the strength of democracies. And Switzerland has, I believe, the strongest rating now. It's the oldest, strongest democracy. The United States is regarded by one of these rating organizations, maybe several of them, as not fully democratic. Not fully democratic. You know, we have things like the Electoral College, and we know, everybody knows about our issues. Switzerland doesn't have those issues, and so a number of organizations regard Switzerland as the oldest true authentic democracy. And it also, of course, is one of the strongest banking countries in the world, in the heart of the second largest collection of democracies in the world, in Europe. And so it just gives an alternative place for custody. This isn't for everybody, but if you do want to open an account, we can help do that. I would think the minimum that you would need to really do is about $250,000 to sort of make it worth it. I wouldn't go open this account for $10,000 or so, but we'll see. Maybe it'll work for $50,000 or $100,000 accounts. Okay, let me get to some topics that we'll talk about today. I'm just going to touch Ukraine very, very quickly. The last webinar we did was on February the 25th. The day after the invasion of Ukraine, and my presentation was all about that on that day. And I said at the time that it was my view, and a view I've held for a long time, that Vladimir Putin is the black heart in the middle of a lot of the world's problems. And I think maybe a number of people on February 25th, maybe people thought that was a little strong. Well, here we are, you know, what are we, 2 months later? And I think that now people can see why I made that comment. What we now have 2 months from the beginning of that war, special operation, as he calls it, what we know is that the Ukrainians are fighting, and fighting hard, and winning in many cases, although they still face a tremendous uphill battle. And we also know that the Russian government and its army is practicing warfare on a really barbaric scale, having destroyed many cities completely, and has been making war on civilians. And those are two things we know. We know that the war has strengthened the Western alliance, and that we now have a war going on that is not only a hot war between two militaries, but an economic war as well between the West and Russia. Russia announcing yesterday that it was going to halt gas shipments to Poland and another country, I don't remember who it was. And of course, the West, which has essentially abandoned Russia from an economic standpoint. and all of this has resulted in a slowdown in global growth. United States announced today that gross domestic product for the first quarter of this year was negative based on exports. The good news is that the fall in GDP did not reflect a weakening of business investment and consumer activity, which remains strong. And so many observers say that the first quarter number for GDP was an anomaly. But we will see. And what we can say about the war in Ukraine now is that it ain't going to be over soon. President of the United States today requested another $30 billion for support of Ukraine. And undoubtedly, a good amount of that will make its way to businesses that make food or certainly weapons. And so we'll see the effect that has on the economy. But the other big news of the day out of the U.S. government is that the Congress, by a vote of, I think, 417 to 10, an overwhelming vote in the House, has authorized the president to reinstate the Lend-Lease program. You may remember Lend-Lease was the major program used by Franklin Delano Roosevelt in response to the desperate requests of Winston Churchill and the British people in the early days of the Second World War to provide material, to loan material to Great Britain. And now that exact same law is being dusted off to be used for Ukraine against Russia. Okay, that's enough on Ukraine. I'll talk about interest rates in the talk today and spend a pretty good amount of time talking about it. And I'll do some talking about inflation. Let's get straight to the slides. And here is the S&P 500. Let me turn on my drawing tool. And we're you know, you can see where we are. We're right here. We have come down from on the S&P 500. That peak when we were around a price to earnings ratio of 20 something, and we're now around 18.2 on April 26, which is yesterday. So 18 times earnings on the Standard & Poor 500. If we go back to February 9th of 2020, right before the pandemic, we were at 19.2. So we actually had a more expensive market back in February, which would have been this market peak right there. And so you got to ask yourself, well, if the market is higher, because clearly, right, it's higher, why are we at a lower price to earnings ratio than we were in February of 2020? Anybody know the answer to that? You can kind of, anybody want to put it in the chat? Why do we have a lower price to earnings ratio now than we did in February of 2020, even though the market is higher now? Who can chat something about that? I'm just going to take a second and see, can anybody say why is that? If the market's gone higher, why wouldn't the price to earnings ratio be higher? Now, somebody says inflation. Well, not exactly, not inflation. Who can say why do we have, let me ask it again, why do we have a lower price to earnings ratio, 18.2 versus 19.2, even though the market clearly is higher, right? I mean, we're up here versus in 2020, we were here. Somebody says it's a ratio, not an absolute number. That's exactly right. Somebody says earnings are down, but the answer is absolutely the opposite. Earnings are up, right? Earnings are up. The denominator, right? I think that's right. Earnings are up now versus that period, right? We have higher earnings now. And so because the earnings have gotten bigger, I think that's right. We've got higher earnings at this point. And so that's why the PE is lower, because the denominator is higher, right? The denominator is higher. So the ratio is lower. So Ravi, you were close. It was just the opposite. So, okay, everybody sees that. And I'm going to show you why earnings are higher. We're going to see that. All right. So this is where we're at. We had a big 34% plunge and we've climbed up and we've fallen off here. And where do we go from here? Who knows, right? Nobody ever knows. All right, next slide. This is a forward price to earnings ratio. And we can see here that we have, again, fallen off from a price to earnings ratio standpoint. We're now at 18 point whatever it is. And we're actually getting close to the 25-year average. So markets are not, you know, insanely overvalued like they would have been here, which would have been 2 standard deviations, right? Here's 1 standard deviation, this first line here, and here's 1 standard deviation to the downside. And you know, here we were getting pretty expensive there. And we've come down to this point where we're a little bit above the average for 25-year average, 16.85. So, you know, the main thing I want people to take away from this call is this is not a bad thing. This is a good thing. It's not good for markets to just keep going up and up and up in valuation, right? That's not healthy. And so you may not like the way your first quarter statement looks, but listen, everybody, it's better to wash some people out of the market who shouldn't be in the market. They're not long-term investors and they're playing around. And a lot of those people have gotten slapped down pretty hard buying a bunch of overinflated tech stocks. And so it's good for the market to wash some people out and teach some lessons. We don't want a market that goes up forever and ever. And so from my perspective, this is a better situation than being way up here in valuation. All right, clear and go to the next page. And here you can see the earnings picture that I was talking about, right? So I was talking about 2020, that would be right about there, right? That bar. And this is where, so this is the level of earnings there, roughly $24 a share for the S&P 500. All right. Well, in 2021, look what earnings were last year. $205. So the S&P, oh, shoot. Sorry, everybody. The S&P, you know, did $205 earnings per share in 2021 and $124 a share in 2020, excuse me, the year of the pandemic, right? And here's 2019. So that's why the PE ratio has come back into line, because prices have come down recently while earnings have come up. So that's good. That's healthy. You know, we don't want stock prices to go up forever. And then this is what's projected for this year and next year and next year, right? So you can see that the good news is that earnings are strong. They were strong last year, and they are predicted to continue to be strong. These are in blue is consensus analyst estimates, right? So that's the good news, and that's why I don't want anybody to feel so bad about the first quarter, right? Prices get better. Now, this right-hand chart, I want to take a look at so that you can see. This is year to date, and this is year to date through yesterday. And this is most of these charts are courtesy of JP Morgan. They do a great job with their guide to the market product that I use, study, and like to present to you. And it's actually updated daily. And so I'm giving you, when I say year to date in this call, that's what I'm talking about, through yesterday, not through the end of the first quarter. So, you know, this is real time. And what you can see here is that earnings, which is this gray line, earnings have grown 7.2% year to date. That's really strong earnings growth. And we're seeing companies report good, strong earnings. But the growth in the multiple that stocks trade at has come down 19.6%, right? So the price multiple has come down while the earnings have gone up, right? Price has come down and earnings have gone up, making for a much more moderate price to earnings ratio than we were seeing last year. And when you put those two together, the total price return on the S&P 500, not including dividends, is negative 12.4%. But like I said, I don't want people to feel bad about that. It's good that we're getting some moderation in prices. It had to happen. And I've said for a long time it needs to happen. And, you know, it's happening now. Will it go down more? I have no idea. But I'm not bothered. Okay. Next page. This is showing you, I'm showing you several of the same sort of information. And this is showing you the two major components of earnings per share growth, of where is this earnings growth coming from? What's causing it? There are two major components. One is revenue, so an increase in revenue. You guys like that better, that fatter ink? Maybe give me some feedback on that. I want to know whether for everyone at home the fat ink is better than the thin ink. I worry that the thin ink is hard to see. So let me know. And then the second component is the margin. Now, who's heard that margins for companies have been going up? Can I see some? Do we have a hand raise thing? Give me a hand raise if you have heard that company margins are going up. I think you go to I don't know. Let's see. Who's heard that company margins have been expanding? Few hands are going up. But not most people. We'll take a look at this right there. Whoop. Look at that. That is the increase in company profit margin. It's not a 70%. So don't, I'll tell you what the 70% is. It's not a 70% growth in margin, but you can visually see that going back to 2001, there is not a greater period for either margin expansion, such as here or here or here, or margin contraction, which usually denotes a recession. This block of gray right here is the single largest amount percentage-wise of margin expansion. And so are we getting inflation? Yes. Are companies taking advantage of that to raise prices more than the increase in costs that they are experiencing? It sure looks like it, doesn't it? Doesn't that look like it? When you go to Home Depot or whatever, and the $1.99 thing is now $2.99, right? That's a 50% increase in margin, and people may just go, I don't know, it's $2.99 now. It was $1.99. But if Home Depot sells enough of that stuff at $2.99 and their costs have gone up, whatever, 20 cents or a dime or something like that, they have a bigger margin. Now, where is the other component? The other component is just sheer revenue, right? Sheer revenue, greater sales figures, and that's gone up 3.8%. So when you put these together here for 2021, this is for last year. If you look at these for last year, we had 8.4%, right? And then we've got this big margin expansion here, right? And so what we end, I think that's a wrong number. I don't think they have that there. That's not right. I don't know, maybe it is. So we get to this big earnings per share number from these two components. And then what you see here on the 70% is that the year over year earnings per share growth is up 70% over the prior year. This is the pandemic year. So in 2021, last year, we had 70% growth over the drop from 2020, the year of the pandemic. And that's why stocks rebounded so strongly, because of this. All right. Where are we in value and growth? Value and growth styles. I've talked a lot over the last few years about the relative overvaluation of growth and the relative undervaluation of value stocks. And I've talked how our portfolios tilt toward value stocks. We have growth in the portfolio, but we tilt toward value stocks. We have a tilt because over the last 100 years, value stocks have outperformed growth stocks, and I would expect that they will continue to over the long term. They don't do it every single year, but it's generally accepted in our profession that you get paid to hold value stocks over growth. It hasn't been the case in the 2015 to 2020 period, but boy, has it turned around. And you can see that right here at that level in 2021, we hit a trough with value being cheap and growth being expensive. The only time previous to that was more pronounced was here in the tech bubble, when everybody was buying Dell Computer and Enron and WorldCom, and everyone was trying to get rid of their Coca-Cola stock and their Procter & Gamble stock, and nobody wanted those stocks. And then look what happened. In the height of the tech bubble right there, people lost a lot of money. And we're starting to get a little bit of that. We've turned around, we're right here, but you can still see that the long-term average of value and growth is right there. We're still below it. And so there's still room to run, I believe. And you can see on the right-hand side, the S&P 500 sector correlations to the US 10-year Treasury yield. So in other words, as the 10-year Treasury yield goes up, and we're going to talk about that pretty soon in this talk, what's happened with bond yields in the first quarter, as the 10-year Treasury yield goes up, what is the price return for different sectors? And what you can see here is that financials do very well when Treasury yields go up. Energy does very well, and industrials do well, and materials, right? Tech, just okay. And some of these are negative, utilities and real estate, although utilities had a strong first quarter despite this correlation. So in other words, in a rising interest rate environment, those industries that tend to be value versus growth, which tends to be right here, do better in a rising interest rate environment. The valuation of the top 10, I'll give you an update on that. You can see back again during the tech bubble that the top 10, Enron and Dell and Cisco Systems, that the top 10 companies reached, back in the tech bubble of 2000, reached a price to earnings ratio of 40 times earnings. Look at that. Look at that. And then fell off a cliff. And very recently, the top 10, you know who they are. They're you know, Apple and Microsoft and Amazon. By the way, Amazon released earnings right before I started this call. They posted their slowest growth in a couple of decades. Stock is down 10%. So we started to see, we are seeing growth companies that really did well during the pandemic hit some rocky areas. And I'm going to show you a couple of those stocks in just a couple of slides. And you can see that these top 10 stocks have begun to come down in their price to earnings ratios, right? Everybody can see that. So currently, the top 10 companies have a price to earnings ratio of around 26.6. All the remaining stocks in the S&P 500, 16.5. So you could make an argument that the portfolio that is expected to have the better return over the long term would be S&P 500 minus 10, right? Maybe somebody should make that mutual fund. Probably would do very well. I ought to patent that. We'll call it S&P 500 minus top 10. And my guess is that if you owned the S&P 500 minus top 10, you would probably do better than if you held just the S&P 500. I'll have to see if there's a fund like that. I haven't heard of it, and I watched the new releases pretty closely. But you can see that all of the other 490 stocks in the S&P 500 are trading at 16.5 times earnings versus 26.6 times earnings. And the valuation dispersion in the market currently, you remember that I've told you before that we have been in a period where the difference between the most expensive stock and the least expensive stocks has been incredibly wide. Sorry, it's not there, but you can see it in this section here, this period we've been coming through between 2020, 2021. Look at the difference. The least expensive stocks trading around 10, 11 times earnings, and the most expensive around 30. So that's a very broad dispersion versus this period right here, right? When we had stuff in 2009 during the financial crisis trading at 7 times earnings on the bottom and 15 times earnings on the top, much tighter spread between the most expensive and least expensive. But look at this spread right here, matched only, and I think it exceeds, these periods here. And so what I've been saying is that ain't gonna last. It ain't gonna last, and this stuff's gonna come in, and sure enough, you can see right here that this peak right here has fallen off, and we have come back on the most expensive stocks. So these things trading at 35 times earnings have come back to 30 times earnings, and they may not stop there. They may not. International, here's an update on international. International, still cheap, although it's come up a little bit, but relative to the US, still cheap. international market versus, international market excluding the global market excluding the US. Let me say it that way. The global market excluding the US, 13.2 times earnings. That's the, that's the 20-year average. Right now, 12.4. So international stocks right now trading 12.4 times earnings, lower than their 20-year average. And they were already inexpensive relative to the US before the Ukraine invasion. And of course, that's rattled a lot of people about the European countries and their stocks. And, you know, when Louis Vuitton has to pull out of Russia and 150 million people and close all their stores, well, you know, that has an impact. So they were already, companies like that were already inexpensive, got even less expensive. Versus here in the United States, 15.5 is the 20-year average PE and trading at 17.6. So the US is more expensive than its 20-year average PE. Outside the US, less expensive than its 20-year average. Okay, so and you can see that we are 2 standard deviations cheap. 2 standard, so not kind of cheap. That's kind of cheap. This going back to 2002, pretty dang cheap. Now maybe there are good reasons for it to be cheaper. You know, maybe people all over the world outside the United States don't believe in making profits anymore. You know, but I kind of doubt that. So we'll continue to invest you internationally because at some point that dog will have its day. All right, valuations. I hope I'm not boring anybody today. If I'm boring you, raise your hand. This is, so here's year to date, right? We're talking about first quarter. Here's year to date. Look what has happened between value and growth. Here's value. It's not pretty, you know, down. Large value companies down 5%, medium value companies down 6.3, small value companies down 9, but growth downright ugly. Down almost 20, down over 20, down 22. Year to date. This is January 1 through yesterday. So you see that if we tilt your portfolio that way, which is what we do, then, you know, have you lost? Yes. But have you lost as much as if we tilted you toward growth? No. And in fact, our portfolios are outperforming their benchmarks now by about a couple percentage points. When I'm having client meetings and we pull out the performance reports, and you can look at your own reports, you'll see we're beating benchmarks by about 2%, which is not nothing. Substantial. What else can I show you? Oh, these are good too. So since the market low in March of 2020, during the pandemic, when the market crashed 33%, you may remember that went on for about a week or two. What has the performance been? Well, look, during the year of the pandemic, people couldn't get enough of buying the stock of Netflix, and they couldn't get enough of buying the stock of, well, Zoom, what we're using right now, you know, or Amazon. And so the whole world was watching Netflix, staying at home, watching Netflix, Zooming with their relatives, and ordering from Amazon, right? And people just buy the stock, buy the stock, buy the stock, all right? Well, look what's happened now that we've had a longer time period from the market low. You see small value has outperformed small growth 120% to 66%. Medium-sized value companies have outperformed medium-sized growth companies 119 to 74. And not nearly the discrepancy, but look, large value companies have now outperformed large growth companies if we go back to March of 2020. So I know a lot of people back in 2020 may have been listening to me saying, I don't know. In fact, I lost a client or two people who couldn't get enough of the really expensive, high-flying stuff. And they just said, you know, we like you, we think you're a great advisor, but we're taking our money and we're going to go invest in Spotify and Amazon. And I'm like, look, now look where they are. You know, not bad, but we've outperformed. And where things are priced is still, look, so small value is still priced at 79.7% of its 20-year average PE versus large growth, overpriced compared to its average. So you see that the value segments of the market, I'm not saying they're going to put up positive numbers, but they're still more attractively priced versus averages. Okay. Enough of that slide. What are sectors doing this year? Pretty interesting. Well, here's the energy sector. It is 4% of the Standard & Poor's 500. That's it. Versus the technology sector, which is 26% of the S&P 500. That is how much the technology sector has grown as a part of the economy versus the energy sector. But here in 2022, year to date, the energy sector has done 34% and the tech sector is down 20%. And we know why. You know, when Russia invades Ukraine, you know, and all the oil's getting cut off and the pipeline's getting shut down, you know, that tends to happen. What'll it be next year? Who knows? I've had people say to me, I had some clients this morning say, well, I want to buy natural gas. And my response is, why do you think why is your view of the future trajectory of natural gas prices, you know, more insightful than where the general market has priced natural gas today? You know, wherever natural gas is trading today in a global market, that's the fair price. You know, we don't know where it's going to go next. And so this is what's happened. What's going to happen, we don't know. And I'm going to show you oil prices too. It's a good thing that, you know, we didn't go chasing oil prices when they leaped up. Other sectors that are interesting, communication services down 23.8% year to date. Consumer staples up 2.5%. So all your cereals and food and potato chips and soda water up a little bit. There I said I told you utilities were up a little bit, even though interest rates are higher. And when you put it all together, stock market, S&P 500 down 12% for the year. Let me show you some individual names and what's kind of going on with some individual names. This is Netflix. And you can see that Netflix, going back, this is around 2017 right here, you know, it's had some ups and some downs, but pretty long ride. And look what occurred here during the pandemic, just this nice climb here. And then look what has happened to Netflix lately as its subscriber growth has slowed. This is what happens with growth companies when they don't make their numbers. That is what happens. How much of a decrease is that? Well, the stock at the peak was trading around, what is that, anybody? About 700. And the stock today is around 200. So what is that? What is that loss? Who can do the math on that? I'll give it to you exactly. $700 divided by 200 equals that minus 1. Oh no, wait. So that's wow, that's a 72% loss in a common name that everybody was chasing. You know, everybody wanting Netflix stock, And if you bought it here, you've lost 72% of your money. Imagine if I lost 72% of your money on something. Imagine that. What would you say to me if I bought something and lost 72% of your money? But that's the Netflix picture. Here, I'll give you another one here. Let's see. Clear. Annotate. They ought to make it easier to clear your drawing and go to another page. Here's Meta Platforms. Anybody ever heard of that? Meta Platforms? Also known as Facebook, right? There it is. So, you know, Facebook had a good day today. It apparently had some good news in its earnings, but it hit this point here, right? Everybody couldn't get enough of Facebook. And then whomp, subscriber growth slowed. And so Facebook's gone from roughly 384, right? And it's up a little bit, but at 52-week low, 169. I guess that would, yeah, 52-week low, 169. So what is that? That is a drop of at a 47% loss. 47% loss. What if I tagged you with a 47% loss on your capital and something? So I want people to, I'm putting these slides up so you see that, you know, when things get frenzied, watch out. You've got to have some discipline, or you can really, you know, Netflix and Facebook, these are common household names. Just because they're great companies with products that people use a lot of doesn't mean they're great stocks at any price. So I want everybody to be careful of that and make sure you understand that. Those are great stock and great companies are two completely different things. They can be the same. That is true. You know, and over the long term, that can be the case, but it's not always the case. Here's ExxonMobil, same period of time, 5-year period. And it's the inverse, right? The other charts we were looking at looked like that. This one looks like this, right? Where Exxon down, 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 down to this point in early 2020, when you may remember the price of oil went negative, right? And Exxon stock hit around, looks like around 37 or something like that. Is that about right? About 37? Down below here, right about here, you know, about $37 a share. And where are we today? About $86 a share. So the return on Exxon from that low is 130% return. So this is why we diversify you. And in fact, by tilting toward value, we've given you a larger return, because the value investments we make for you will hold something like ExxonMobil in a larger quantity than it would normally be held in just the S&P 500. And so that's why we're getting some outperformance. Okay, hope those were helpful for you to see, just to put some individual names as to what we've been seeing. This one I like to show everybody, intra-year declines. And I'm sorry, I'm really going slow on time today. But I'll see if I can speed up. But this is showing you every year there's a decline in the S&P 500, and with this year's no different. There it is. We've seen a maximum decline of 13%, and where are we right now? We're at 12%. So we're pretty much near the market lows for the year. But as you can see, every single year, just about going back, you know, here's 1980, you know, every single year we have some time in the market during the year when things go negative. 34% here, that was the pandemic. And so this year's no different. No different. So I want everybody to see nothing abnormal going on. It's all normal. Don't be thinking that there's nothing, you know, things are different. They're not. They're not different. This is an interesting chart. This is a consumer sentiment index. And what's interesting is that when consumer sentiment is at a high, this is just the big picture here, the subsequent 12-month returns for the S&P 500 are right here. So in August of 1972, consumer sentiment hit about a reading of 95 or so, which is above the average. So it's on the high side. 6.2 was the return to the S&P 500 12 months after it hit that mark. And here it hit another peak here. 1.2 was the subsequent return. 13.5 when sentiment hit a high in March of 1984. And then we had a period of decline and then up. Here's January of 2000. Very, very high sentiment. Everybody euphoric about the internet. 2% was what the, negative 2% was what the return to the S&P 500 was after that. Another high here, January, 4.4, 4.2, to negative 2.7. And then here, February 2020, a 29% return on from that peak, and that went through the pandemic. But look on the opposite side, when consumer sentiment is not strong, look at the returns for the S&P 500 in the subsequent 12 months: 22%, 20%, 29%, 32%, 14%, 22%, 15%, 43%. You don't need me to calculate what the averages are, that you can see that clearly when consumer sentiment is on the lower side, market returns subsequent to that trough, nadir, have been stronger. And where are we right now? Well, we don't have very strong consumer sentiment. So that's sort of the good news, is that you know, if history holds, we might get some positive returns over the next 12 months. I'm not guaranteeing it. This is not any sort of ironclad thing, everybody, right? But I just want you to see that when sentiment and why is sentiment poor right now? Because of inflation, you know. So we'll see. But I did want to show this slide. I thought it was an interesting slide to show everybody that that when you hit these nadirs down below here, the market's been pretty good, sometimes very good, subsequent to that. Inflation, you know, what can I say about this? Here it is, you know, whew, big leap up. You know, when have we had leaps up like that? Well, you know, here was this big one in 1973 with the war, the Middle East war that began during Yom Kippur in between Israel and Arab nations. It came back down, and then we had this. This was the Iranian hostage crisis, I believe, when oil prices went up again. And it seems that almost every time this happens, you know, what's the culprit, right? in each of these really steep rises, you know, but in each of these, they hit a peak and they came back down, hit a peak, came back down. Inflation did, you know, so who knows? I don't know how far it's going to go. But the good news is that, and the other thing I want to say about inflation is that I want, and I've said this to a number of clients, I want everybody to understand that we're not getting inflation the way that Argentina gets inflation or the way Russia's getting inflation. We don't have a loss of confidence in our currency. The dollar is strong, especially now. And so we don't have a monetary inflation. That's really what I consider to be, you know, traditional, authentic inflation in the way that the word is meant, the debasing of the currency, the loss of confidence in the currency. We're not really having that. We're having price increases in different sectors, right? That's what we're having. And so is it inflation? Yeah, but it's not nearly as big of a problem as if there was a loss of confidence in the people's willingness to hold the US dollar or to trust the US dollar. We've got a whole bunch of supply chains that are having price increases. And so I want everybody to think that way about it. And you can see here are the different components of inflation that we are experiencing. And you can see that, back in March of 2021, we had 2.6% inflation. We had some energy inflation, which is the green, but there was not much restaurant inflation to speak of, as people were not going out at that point. And so restaurants were kind of squeezed. Food at home, we weren't seeing any sort of large scale food price increases. We had some, but not a lot. And contrast that to March of 2022, 1 year later. And look, here we are at 8% inflation versus 2.6% inflation. And all of these different sectors, energy, new and used vehicles, food at home, other, restaurants, hotels and transportation, and shelter, all these different categories, we see meaningful across the board, sector by sector inflation. JP Morgan says, well, maybe these categories are transitory: energy, new and used vehicles, and food, meaning these may come back, and they have a question mark. They might come back. We're asking, these might be more sticky: housing, restaurants, hotels, and transportation, right? In other words, we may see prices moderate in these, or inflation moderate, but we may not here, especially because these are what? These businesses are particularly labor intensive, right? And we have a wage inflation going on in those businesses, and so it may not be as transitory there. Who knows? We don't know. Pretty interesting slide, though. All right, oil prices. I'm sorry, we're at the top of the hour. I'm just going to keep going. If you got to drop off, I totally get it. I understand. I've got about, I don't know, maybe another 7 slides or so, and then we'll get to questions. But I do want to cover all the slides. I worked to put them together, so I'm going to get through them. Sorry to run long. Oil, you see here was the peak that we hit. That was around $125 a barrel. We've come down some. Pretty meaningful amount. We've come down, good 20% or so, and we're around $101. It's not, we're not back to $80 oil. We're not back to $60 oil, but we're not up at 120. We're somewhere around right there right now. As the world has adjusted to what's going on with supply, and people are having to work out, and maybe some people are driving less. It's such an important commodity that all sorts of things figure into the price of oil. And that is the thing, is that high prices, and look at that one, July 3rd of 2008, that was a couple of months before the breakout of the great financial crisis of September of 2008, when Lehman Brothers in September, and Bear Stearns and all those companies, we hit this big peak here, 140. That may have been an all-time high. I suspect it is, but look how look at the drop in oil price that occurred at that time, down to $33 a matter of months later. Look at that. That's an amazing, amazing. I don't know that I've ever seen such a steep drop in something. And then look at this, down to, in April of 2020, oil $11.57. This was the pandemic, and remember, for a little bit there, it was below zero for like a few hours. I guess they didn't put that in the chart, but for a few hours, we actually saw, one day we saw oil trade negative. But look, since then it's been up, and so that's when you see Exxon stock chart, you can see why the price of oil has contributed to Exxon's improved fortunes. The global energy transition. Just a couple slides about this. This is happening, everybody. You may think that this is fake news or whatever, but it's not. Look at the increase in global investment in an energy transition, billions of dollars. Okay, in 2004 we were at $30 billion, right? Global investment, total investment. We're now approaching $1 trillion in total investments in both renewable energy and storage, electrification, and carbon capture. So look at that. And then look at this amazing, amazing chart. the price of different types of energy. Nuclear is here, it's kind of risen. The price of that has risen. Coal has sort of flat. Natural gas has fallen some, and this is 2021, right? Wind has fallen in price and is right around the same price as what is that? Same price. Oh, I'll tell you what the same price is as this. Look at what solar has done. Look at solar power. Look at the cost curve that solar has come down from. In 2009, solar dollar per megawatt, $350. And now it is the lowest, along with wind power, at around 50, and is cheaper now than nuclear, coal, and natural gas even. Those are the numbers. So we have a global energy transition that is happening, and the war in Ukraine is, of course, only going to accelerate that. And so I expect a good amount of global growth to come from this, because these are high return projects, very capital intensive, but very, very good high returns as we make this transition. And of course, good for the planet too, because we're facing, we're facing some environmental problems. Emissions targets. This is, you can see that these are the countries' greenhouse gas emissions targets. Are the countries serious about these? I don't know. China talks about this, US talks about this, but US and Europe are targeting zero emissions by 2050, China by 2060. This is the current policy forecast in here. Who knows? But that's what is being stated as a goal. And look at the change in the energy profile: oil use, coal use, natural gas use, nuclear and hydro going up some, and look at renewables, wind and solar by 2040, 2050. All right. So good slides on that. Now, let's get into some interest rate talk, and then I'll be done. This is, as you know, the Fed has raised short-term interest rates recently to 0.38, right? And they're not done. And eventually, these are Fed forecasts and market expectations, all these different estimates and long-run projections, but they're all up in this area. And so, and they're there by 2024 or so. So everybody needs to expect that we may see 2% plus on short-term federal funds interest rates, because remember, the Fed does not set long-term interest rates, only short-term interest rates, but that's where they're going. And it's going to be interesting to see how they get there. So this is why you've earned nothing on your money for a long time, except a little bit in here on your cash deposits. But the Fed is expecting that you'll earn a little bit on your cash deposits. And then the Fed balance sheet. Everybody knows that the Fed has taken extraordinary measures since the financial crisis, and started to purchase, of course, treasuries, as the Fed has always done, but purchase mortgage-backed securities and some other loans here. And by 2022, this point earlier this year, the Fed's balance sheet had grown to about almost $9 trillion. And what they are projecting is that it's going to fall from here. The Fed is going to shrink its balance sheet. We'll see. That's the stated goal. But I think what we can say is that the extraordinary measures that began in 2008, continue 2010, 2012, 2020, all these QEs, quantitative easing, but that's over. There's not going to be a QE5 unless everything falls apart. Interest rates and inflation, we can see that the nominal 10-year Treasury has now gone to 2.77%. It was trading right here at 0.5% in August of 2020, now at 2.77, and a huge amount of increase this year alone in the first quarter in the 10-year Treasury bond, which is what's caused a lot of the decrease in bond prices and the bond part of your portfolio. And this is the real rate, right? So this is the real rate is the real yield rather is minus 3.66 because inflation is high. So inflation is 6.44, subtract the nominal yield and you get the real yield. And so just at the time that the 10-year Treasury and other bonds as well have seen their yields rise, inflation has risen also at the same time. And so we're not getting a positive real yield. This is a problem. This is a conundrum. And how it works its way out, I don't know. But that's the picture right now. It's very, very tricky in the markets right now because of interest rates, and not just for bonds. I want everyone to understand this is not just a bond issue. It's a stock issue. It's a real estate issue. Everything is impacted by interest rates. And this change in Fed policy and turn is going to have impacts. And you can see right here what bonds did in the first quarter. Look at this, or what they've done year to date. The 2-year Treasury down almost 3% year to date. The 5-year Treasury down almost over 6% year to date. Treasury inflation protected securities of longer duration. You may have seen that we made a trade in your portfolio recently. We have emphasized shorter term inflation protected bonds, which has done very well in comparison. And the other day we sold out the rest of our longer term in favor of shorter term to reduce inflation, interest rate exposure in the portfolios. Look at the 30-year Treasury bond year to date, down 18%. So that's how volatile a very long-term Treasury bond can be in a rapidly moving interest rate environment. And you can see all the rest of these bonds that are not Treasuries, corporates and convertibles, and look at municipals, 8% down. So, that's what bonds have experienced here in the early part of 2022. Now, does that mean that they're going to continue to do that? We don't know. It could be that the market is perfectly happy with these yields and that it sticks here. There's just no way to know. You cannot predict interest rates. It's just an impossible thing. Just a couple more slides. We'll do questions. Here's the yield curve. Always something to make sure that we take a look at. And what you can see is that this curve was December 31st, New Year's Eve, and look where the 10-year Treasury, I'm sorry, that's the 30-year Treasury. The 10-year Treasury, 1.5%. Look where it is now on April 26th, yesterday, 2.77. So you see the whole curve has shifted upwards, the yield curve. Even the Fed here, this is what the Fed controls right here. This is the very short-term stuff. Even the Fed has jumped up a little bit, right? Right? The 0.39. But look, you are not getting paid. Here's the 2-year. You are not getting paid a whole lot more between the 30-year and the 2-year Treasury. That's called the 30 to 2 spread. And there ain't much spread. Look at that, right? You are being paid essentially the same interest rate, roughly, here as you are to loan for 30 years, right? And so something's got to give. Something's got to give, because if the Fed keeps raising this short-term rate, is this going to go up? Is this going to continue to go up? If so, then if you own 30-year Treasuries and we don't, the price is going to continue to go down as it has this year, down by 18% in the slide I just showed you, right? Normally we have an upward sloping curve, right? The longer you lend money for, the higher the interest rate is, right? We have a flat interest rate curve. And if it goes negative, meaning the short-term interest rates are higher than longer-term interest rates, we have what's called an inverted yield curve. It's inverted. Rather than getting an upward sloping curve, we have a downward sloping curve. And sometimes that heralds a recession. So we watch that. Doesn't always, often doesn't, but it can develop. I'm going to skip this slide. And this is the last slide, then we'll do questions. And again, I'm sorry to have run long here, but That's the way it is. This is just a slide. This is a sampling of individual investors, I think, that Morningstar does. And I'm just showing you where portfolios from this 5,000 person sampling is at, what allocations look like of a 60-40 portfolio, which is sort of standard portfolio. US equity remains 47.3, non-US equity 15.3, US bonds 23.9, non-US bonds 5%, cash. That's a standard portfolio. I'm just showing you sort of what everybody else is doing and what are the changes that have occurred in portfolios recently. People are holding a little bit more cash. They're holding a little bit more international, holding a little more mid cap, and they've been selling some large companies. They've sold some short-term bonds and they've sold some other bonds. Okay, that's it. I'm going to shut up now, and if there are any questions, I'll be happy to take them.
So yeah, if anyone has questions, feel free to type them into the Q&A session. There's nothing quite yet.
If there's no questions, I'll go home to dinner.
No questions in yet, right this second. If nothing comes in the next few moments, then just note that today's webinar will be released on the New Capital Journal, which will go out tomorrow. That's it. Still nothing.
Means I answered all the questions.
Okay, thorough. All right, I guess we will call it. So thank you again.
Hang on, going once. Going twice. Going three.
Oh, we got one. One on the chat. How will the ruble affect the U.S. dollar, or the ruble affect the U.S. dollar as the world currency?
The ruble will not. The ruble is very powerless compared to the U.S. dollar. Very powerless. The ruble has been powerless as long as I've been alive and beyond. Russia has never been any kind of monetary powerhouse, so the actuality of Russia has often failed to live up to their ambitions. This is the problem with Russia. Russia's ambitions have always outstripped Russia's reality. And Russian dictators get big heads from things like nuclear weapons and, and whatever, oil prices. And then they do things that are far beyond their reach or their grasp. And so the ruble has no effect on the U.S. dollar. I don't want to say no effect. Very, very little effect on the U.S. dollar. The U.S. dollar has a major effect on the ruble. Major effect on the ruble because the dollar has traditionally been used in Russia in black markets and off markets and other places for people in Russia to store their wealth in dollars because they don't trust the ruble in Russia. And so a strong dollar has caused people in Russia, when the ruble has been weak, to hoard dollars, and including the Russian government to hoard dollars. So the US dollar has always had a very strong impact on the Russian ruble. And so rather than the Russian government and the Russian people, we'll call it the Russian manifestation, saying, we ought to take it as a little hint there that our currency is not desired in circulation worldwide by other people. The US dollar is. We ought to just sort of develop our country to the point where, because that's what the Chinese have done. The Chinese have said, we're going to develop our country economically and develop the yuan to be in a position to challenge the US dollar. It isn't there, but they have the idea that it will be. And they're taking steps from an economic standpoint to do that rather than as much from a military standpoint, although China's got its own problems, But the Russians just say, oh, well, we got a bunch of nuclear weapons, and we're not even going to take notice that our currency has no value outside of Russia. and is weak compared to the United States. So it's a good question. I wouldn't worry about the ruble. Stranger things have happened, I guess, but it is the US dollar that has a major impact on the ruble. And in fact, we're seeing this play out because the Russian government has said that it's going to only allow it to be paid in Russian rubles rather than in dollars for oil exports. And the reason is because the US central bank and other central banks have put a freeze on the ability of the Russian government to convert their dollars. And so if they get dollars, they can't do anything with them. And so they have demanded that they be paid in rubles so that it supports the value of the ruble. And that has worked. Russia has a very, very smart chair of their federal bank, a woman named, I forgot her name, very, very smart. She tried to resign when the invasion broke out. Very, very smart economist. So it's not like, they're idiots. They've got very, very qualified people, but Putin's in charge. And so whatever he says, that's what goes. Okay, any other questions?
Yes, there was one more that came in. It said, can you elaborate on the quote unquote greed factor in this round of inflation?
By that, I'm assuming that what's meant is that people or entities are using the inflation numbers as an excuse, whether they are experiencing inflation or not, or whatever inflation they are experiencing, they are overdoing it and raising prices even more. And I don't have any numbers to back that up other than to say, to go back to that chart I showed you early, that margins have been expanding. Is that greed? I don't know. I'm not able to assign an emotion to it. I'll only say that, there was a very tight lid on prices in the United States for many years with low inflation, with the exception of certain segments like healthcare and like education, right? College education, two notable areas where those two segments were simply like immune from the low inflation that we experienced for really a couple decades in the United States. And now that the wheels have come off, I think that there is probably, I don't want to say it's greed. I think there is pent up upward pressure on prices for a variety of reasons. Labor has its own reasons. Retailers may have their own. Restaurants got crushed in the pandemic and became uneconomic entities, and so they're trying to make it back. So I don't know that it's all greed. For some it's fear, for some it's just for some it could be anger. There are sections of the labor population that probably have anger. So I don't know that it's all greed, but I will say that there are different segments being motivated by different emotions, and there are segments that probably are being motivated by greed, but not all of them. So that's my answer, that there are different emotions impacting different inflationary segments of the market. We have not raised prices and are not going to, by the way.
No other questions are in at the time.
That's a good note to end on, the one I just ended on. Okay, everybody, thank you very much. It's been great to be with you. Thank you. I really enjoy these calls, and I'm particularly grateful to those of you who join regularly. And I'm also grateful to those, if there are any of you who've joined for the first time. And I'm especially grateful to Catherine, who I could not do these sessions without. So thank you very, 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 very much. And glad your husband is back at home.
Yes, me too.
After getting bit by the cat.
Yes, 3 nights in the hospital. That was interesting. So
Yeah.
It's my pleasure, and it's our pleasure to be with you all today.
Thank you. Bye, everybody.
Bye.